Hey guys, Jack here from FX Education. If you've traded signals before, you probably know how effective they are at depleting your trading account from hero to zero. But do you really know why they don't work? So, before you fly off the hinges and start defending your signal provider in the comments, claim that you make those sweet profits, just hear me out. The first reason is pretty obvious, and that is your signal provider can't actually trade, is in sending you signals from a half-baked, unprofitable trading strategy. Usually, the way this will work is Joe Blogs, the 18-year-old entrepreneur trading guru with Wi-Fi money in their Instagram bio, decides after smashing their first week on a demo account that they're going to capitalise on a broker deal and become the next best non-advisory financial advice service on Instagram. To add to this, I've come across so many signal services that are just redistributing other signal providers' poor signals. This became extremely prevalent earlier this year when it was discovered that one of the largest UK signal providers were providing signals from other groups and signing them as their own. Not only is that tick the box of the guru not being able to trade, they're also copying off another guru who can't trade and selling them to other people. It's like some sort of guru inception.
How could I ever acquire enough detail to make them think that it's reality?
There is, however, one other reason why the signal provider's trading system isn't right for trading signals, and that is a lack of consistency. This might mean that for months their trading system isn't profitable, meaning that if you're unfortunate enough to join after a good month, you'll have been sold the promises of thousands of riches and Lamborghinis upon Lamborghinis in your drive, and what you'll soon realise is that you're getting suited up for a deep dive into drawdown whilst your account sinks into the red. Don't worry though, if you can't handle a bad day, you don't deserve a good month. Now I bet you've heard that one before. The second reason is that beginners who follow signals aren't usually told to manage their risk correctly. I'm sure we've all seen the Instagram adverts with MT4 screenshots where £300 trading accounts have been flipped to 1,000 in a couple of days using the most ridiculous risk management. If by some complete miracle you are told to manage your risk correctly, it'll probably be the classic 0.01 per £100 of account equity, which makes absolutely zero sense. This is due to the varying pip values on different currency pairs, as well as the different values depending on the size of your stop loss. So you might be wondering, why do these signal providers not tell you to manage your risk? Well, it's pretty simple. Most of the time they're affiliated with partner brokers who require traders to trade a high volume in order to make the brokers money through spread, which in turn finances your signal provider's Lamborghini rental on their biannual trip to Dubai. The other aspect that you need to realise is that once you go into drawdown, you will likely not be able to recover if you go past a certain point. The harsh reality is that after about 50% in drawdown, you'll have to trade better than 99% of other market participants in order to just get your account back to break even. This is due to the fact that only 1% of traders actually manage to make 100% return on their accounts, and I'm pretty certain you aren't getting tips from the top 1% of traders for just £40 a month. The third reason is the time difference between when the signal provider enters the trade and when you receive it. Now it might seem a bit far-fetched that by the time someone has taken the trade, typed it out and sent it to you and you've placed it, that you will have lost any small amount of edge that the signal provider's strategy has, but this really is the case. Let's walk through an example with a made-up trade. Let's say in this instance, you're the signal provider and I'm a humble beginner who thinks pips come from apples and doesn't have any idea about trading. You've just found a beautiful setup on GBP JPY and you're looking to get involved in a 2-hour position, which means that you'll make £2 for every £1 risk. Let's imagine it's a trade with a 10 pip stop and a 20 pip target, and you've entered the position and sent it to the signals group that I'm in at 11 o'clock. Unfortunately for me, I worked at a pub and I was serving breakfast to my customers and didn't see this notification until 11:30. At this point, the trade is in 10 pips of updraw, meaning the trade is in 10 pips of profit. Now when I enter the trade, I have the same target and the same stop, but instead of the trade being a 2-hour position, it's become a 0.5-hour position with a 10 pip target and a 20 pip stop. This means that if the trade goes on to hit target, you will have made 4 times as much as I did with the exact same position. This becomes a real issue over large volume of trades, and it means that even if the signal provider has a profitable strategy that has positive returns month on month, I will still end up losing money. Now as part of my daily YouTube binge, I did see a signal service that Behezo was trialling, where the signals were sent out at a certain time every day. Now this obviously would be a lot easier to follow than sporadic signals being sent at random intervals throughout the day, but remember though, just because it's easier, it doesn't mean that it'll work. The fourth reason why signals don't work is that you can't learn from your losses. When you're trading signals, it's very rare that you'll be sent forecasted setups with information about the setup that you're potentially going to enter later that day or week. This means you aren't learning anything from each trade you're taking and just building a dependency to your signal provider. Let's imagine you somehow found a signal provider that will make you an extra, say, £500 to £1,000 a month from your trading. So you decide to treat yourself to a new car on finance. What happens if the signal provider just disappears and decides they don't want to send their trades out anymore? I think the term for that is being up the creek without your paddle. When I first dabbled in Forex a few years back now, I started following signals and I found nothing as frustrating as the 10 strong losing streaks with zero explanation other than the classic market manipulation, big banks are stop hunting again, or even sometimes the non-farm payroll results which my guru blindly guided me into with 30 times as much risk as I should have been taking for that trade.
Nice.
The fifth and final reason is the cost of the signal service. This point probably doesn't really cross the mind of many beginners when they first get into trading, but it's actually super important due to the fact that even the most profitable signal service might still end up burning a hole in that pocket of yours. I did some research on Fiverr when I was preparing this video, as well as on Instagram, and I found that the average cost of a signal service seemed to be around £45 a month. This will usually include the classic 5 to 15 signals a day sent to your smartphone, and of course their strategy will have a 97% success rate. So why is this important? Let's imagine you're planning starting with a £300 trading account, which is a little under how much I started with when I began my Forex journey. On average, most profitable Forex retail traders will make around 4 to 10% a month depending on their system, with mine personally being around the 10% figure on a good month, while sometimes being considerably less than 4% on a bad month. Let's take this 10% figure and run with it though, because obviously Mr. Wi-Fi Money offering you signals wouldn't dream of only making 4% a month. At 10% per month, you will make £30 in your first month from your £300 account, which actually sounds really impressive, and with a bit of help from our good old friend compound interest, after a few years you can flip that £300 into a few thousand, if you don't withdraw any of the money or have any costs to deduct from that £30 revenue on the account, which we know we do. Instead of the £30 profit, we actually need to do the super simple calculation of monthly profit minus group fees, which would give us our total profit. In this case, £30 minus 45 for the group fees, which would leave us with an impressive negative £15, which is actually a really cool minus 5% loss. So what does this mean? Should I go and find a £45 a month or less signal service? Well, absolutely not. In fact, I wouldn't even encourage you to follow signals at all, but I'm sure those lazy, delusional traders amongst us will enjoy being charged the privilege of losing money. So if you are dead set on following signals, do the math first. Ask for verified track records, which you probably won't get given, and then the group fees. You can then do a pretty simple maths calculation on how much you will need to have in your account to make the signal actually worthwhile and profitable. Let's say you've managed to find a signal provider with a verified track record that shows a monthly ROI of 5%, on average once you smooth out the losses and the winning months. They then tell you they're going to charge you £100 a month on a recurring basis to access the group. This then means in order to break even, you need to make at least £100 on average every single month. If we look at the 5% ROI, that means you would have to have at least £2,000 in your trading account just to break even. Realistically, you're going to want to have at least £5,000 to £10,000 there to make it remotely worthwhile to cover those extortionate fees that they're charging you. So guys, now you know 5 reasons why signals don't work. Why don't let me know in the comments if you've traded signals before, and if you have, how did it go? As always guys, if you liked the video, smash the like button, and if this video gets loads of likes, I will deposit £300 of my own hard-earned cash and follow a signal service of your choice and post my real results. Cheers guys, and I will see you in the next one.